Now we will discuss format of balance sheet in this module. Again, remember that balance sheet is based on the accounting equation assets are equal to owner's equity plus liabilities. So based on that equation, we have to group our assets in an order and owner's equity and liability in an order. And then those assets would be further classified based on a concept, and liabilities will also be classified based on a concept. Let's see. In a balance sheet, like income statement, we will put entity's name first, and then put balance sheet as a title, and then place the date on which the balance sheet is being prepared. Remember one very important thing over here, that balance sheet is prepared on a specific date, whereas I'm just writing here for you that income statement is prepared for a period. Okay, income statement is prepared for a period. Okay, whereas this is income statement. Whereas balance sheet is prepared as at a date. Okay, that on this date, how many assets we do have with us? On this date, how many liabilities we have on us? On this date, how much is the claim from our owners? So remember that income statement is prepared for a period and balance sheet is prepared on a specific date. Got it? Well, we will repeat it somewhere in the next module as well, but remember this, something very important. So in a balance sheet, equation is asset is equal to owner's equity plus liability. Got it? Okay. Now the assets would be grouped like this: fixed asset and current asset, and liabilities as long-term loans and current liabilities. And for equity, you see, we have to do some working capital plus net profit minus drawing, and then we'll get that equity thing. Once again, these two columns are first one is for working. Never confuse it with the debit and credit column. And this second column is the outer column for final figure. Okay? We do not write this at the top, but just keep it in your mind that this is the column for working and this is the column to show the final figure. So what we are doing, in fact, we are putting the figures in front of the title: land, building, machinery, furniture. These are the fixed assets and their total is over there. And then stock, this is the closing stock, debtors, bank and cash, and their total is coming out. And sum of these two is here. And then owner's equity, including capital, net profit, subtract drawings, and their final figure is coming out. And then these are the long-term loans, long-term liabilities, and these are the current liabilities, their figure coming out. So these two figures would always be equal, since asset is equal to owner's equity plus liability. Okay? Very well. So, I will discuss the concept that what are these fixed assets and current assets. Okay? So, first of all, fixed assets. In fact, we can say non-current assets and current assets. But this, again, this is the categorization that we will learn somewhere in the next module or at some later stage, okay, when there would be a difference between non-current and current asset would be discussed over there. But as of now, at this stage, these are the fixed assets and current assets. So fixed assets are in fact the assets which are long-term, normally are used for more than one accounting year, and these are held in the entity either for production of goods or services or supply of goods or services, or these are held for administrative purposes like furniture, computer, etc., or these are held for rental to others. Like if you are doing a business of rent a car, the motor cars that you would be holding in your entity are rental to others. If you are doing a business of like providing crane for construction to contractors, so you are receiving rental against those cranes or construction machinery. So those are your fixed assets, okay? And you are renting it out. So fixed assets are always for long term. And current assets, in fact, the assets which are short term, you can say. These are held for trading, like stock is your current asset, because it will be sold. In this year, it remained unsold, and it will be sold in the next year. For very short term, like machinery will be held for 10 years, supposedly. Building will be held for 50 years, supposedly. But stock will not be held for 50 years. Stock will be held for few days, for few months, and soon after, like we have entered in the next year, might be in a day or two, that stock would be sold. So stock is a current asset. Then receivables, debtors are current assets. Balance in the bank is current asset. Frequently it would be changed. And cash in hand is current asset. Then owner's equity. Owner's equity is the claim of owner on the resources of the entity after subtracting liabilities. So owner's equity at this stage, you will see capital plus profit minus drawings, and long-term loans and current liabilities. Again, the bifurcation based on the time period. The loan that your entity has taken for longer period would not be mixed with the current liabilities. That would be shown separately. And short-term loans would be shown separately as current liabilities. So the important tips that we have to remember in this module, that we have to distinguish between fixed and current assets. We have to distinguish between non-current liabilities or long-term liabilities and current liabilities. And short-term obligations would always be put in the current liabilities. So this distinction is very important in reporting, because based on it, we have to take some decisions. That's why it is very important.